Is my screen visible?
Yes, ma'am.
Yes.
Yes, okay. So today we will see Customs Act. Okay, Customs Act, the the marks that is uh, allotted is about 9 to 10 marks. In that, one question will be a 7-mark question, and then you might get around 2 MCQs. Okay, so customs it applies to the whole of India. Whole of India meaning the territorial border plus territorial sea, territorial water. Territorial water is limited to 12 nautical miles from the coastal baseline. And exclusive economic zone. Exclusive economic zone is 200 nautical mile from the coastal baseline. So this was an MCQ question in your previous attempt. What is exclusive economic zone? So it is 200 nautical miles from the coastal baseline. And beyond that is the high sea. So up till exclusive economic zone, India has power to administer their import and movement of goods and export of goods. What is the tax point in case of customs? Okay. Tax point in case of customs is when they enter the territorial water. So as soon as a ship crosses the territorial waters, it comes under the administration of Indian Customs Act. Okay. Taxable event in case of customs. Taxable event in case of customs, duties are to be levied at specified rates under Customs Tariff Act or any other law for the time being in force on goods imported or exported from India. Okay, tax point, the duty of custom is leviable on goods and not on the person who is importing. The goods shall be imported or exported from India, and duty shall be at such rate as specified under Customs Tariff Act 1975. So chargeability section is your Section 12, which states that on the goods that are imported or exported from India, customs is applied as per the tariff that is mentioned under Customs Tariff Act. It is not on the person, but it is on the goods that is being imported. So Customs Act covers only goods. It does not cover services. Services are covered under GST. Indian custom water includes the territorial water and the exclusive economic zone. So exclusive economic zone, the continental shelf, reef, marine life in the exclusive economic zone comes under the control of the Indian government. Taxable event in case of import. What is the taxable event? Taxable event in case of goods entered for home consumption. Taxable event is the date on which the bill of entry is in respect of the goods is being presented. In case of warehoused goods, the date on which the bill of entry is presented for clearance for home consumption. In any other case, the date on which the duty is paid. So the import, the chargeability happens as soon as the goods enter our territorial water. Then immediately the provisions of Customs Act is applicable. But we cannot collect the tax when it is still in the territorial, in the water, right? It has to reach our land base in order to collect the tax. So when the goods are cleared for home consumption, when they are presented for clearance to home consumption, that is the time when the tax will be calculated and the tax has to be paid. So the date of bill of entry, the date on which the bill of entry is presented for home clearance. In case the goods are unloaded and then they are warehoused and after 2 or 3 days only they are being removed into the domestic market. Then the date of presenting the bill of entry for removal to for home consumption. Okay, that is the taxable event. So you need to remember it is the date on which the bill of entry is being presented for home consumption. Taxable event in case of export. So in case of export, export is completed only when the goods cross the territorial water. But we cannot collect the tax at that point of time because it is the consignment will be in a ship and it will be on its way, right? So we need to collect it at the port itself. So when the goods leave the port or when the ship leave the port, at that point duty will be collected. Okay, so in case of export, the duty is collected when the goods leave the port. In case of import, when the bill of entry is presented for home clearance. That is the taxable event in case of export and import. Okay. Customs duty, there are two schedules, Schedule 1, Schedule 2. Schedule 1 is duty on imports and Schedule 2 is duty on export. Duty on import can be divided into two. One is specific levy where based on the quantity, the levy will be fixed. Like for 1,000 kilos, this is the amount of customs duty to be paid. So that is specific levy. Ad valorem levy is we calculate what is the value of the goods and accordingly on the assessable value, tax rate will be applied as per Customs Tariff Act. Okay, these are the two methods of levy, specific levy, ad valorem levy. So from exam point of view, you need to remember the basic terms because that can come as MCQ. The 7-mark question, consistently we have seen it is a numerical question. It is a case study type question. So only for MCQs, we need to know all this. MCQs, how the MCQs will be asked, you need to know what are the specific terms. So there are two schedules, Schedule 1, Schedule 2. Schedule 1 is duty on imports. Schedule 2 is duty on exports. Duty on imports can be divided into two, specific levy and ad valorem levy. Ad valorem levy can have two different rates. One is preferential rate. If you have any trade agreements with a country, then there will be a specific rate or a preferential rate, or there will be a standard rate. Next, we come to types of duty. Okay, this also can be asked in your MCQ questions, or you might even get a 7-mark theory question asking you to explain any one of this duty. So import duty can be divided into 7 different segments. Basic customs duty, protective duty, safeguard duty, countervailing duty, anti-dumping duty, IGST and GST compensation cess. First one is basic customs duty. Basic custom duty as per the Customs Tariff Act, if the product is eligible for a preferential rate, then the preferential rate will apply. If a standard rate is mentioned, then the standard rate as per the Customs Tariff Act will be applicable on the assessable value of the goods and the customs duty has to be calculated. So that is basic customs duty. That is the base tax or the base duty that has to be paid as calculated on the assessable value of the goods. Okay, generally we have seen it is around 10%. Then on basic customs duty, you have a cess applicable. Okay, that is 10%. So in your exam question, if they say calculate basic customs duty, it is implied that you have to calculate the cess also and then identify what is the total duty payable. You cannot just stop with basic customs duty 10%. You cannot stop with that. You have to add a social welfare cess of 10%, social welfare surcharge of 10%, and then calculate what is the total basic custom duty payable. Okay. Basic custom, so the social welfare surcharge is not applicable for safeguard duty, for countervailing, anti-dumping, IGST, for other type of duties. This surcharge is not applicable. Surcharge is applicable only on basic custom duty. Okay. Then protective duty. Protective duty is charged if the government feels that this particular industry is subject to a threat of excessive import that might affect the domestic industry. So before happening of the event, based on the recommendation of the Tariff Commission, government is taking a proactive action, charging a protective duty to protect this industry from any kind of malpractices or excess imports of foreign products that will affect the domestic market. That is protective duty. So it is based on the recommendation of Tariff Commission. It is to monitor the industries where there is a threat of excessive imports. There is a threat to the domestic industry. Next, we have safeguard duty. Safeguard duty, when the central government is satisfied that an article is imported into India in excessive quantity and such article is imported so as to threaten or cause an injury to the domestic industry. So protective duty is a proactive step taken to protect an industry where they see a threat of excessive imports. Okay, safeguard duty is after happening of the event. Government has found out that there is an article that is being imported into India in such excess quantities. Okay, and it is imported in high quantities that it is giving a threat to the domestic industry. So in that case, they have to take immediate measures to correct what has gone wrong. So they charge a safeguard duty. Safeguard duty where an article is originating from a developing country. Okay. The aggregate import from country or countries shall not exceed. So how to identify that a product is being imported in higher quantities? By using these two threshold limit check. Where an article is originating from a developing country, the share of import of the article from that country does not exceed 3% of the total import of that article into India. In case of developing country, 3% is the threshold limit. Okay, if it is a mobile phone, what is the total quantity that is being imported from that country? It should not exceed 3% of the total articles. So if I am importing 10,000 mobile phones, totally India is assuming totally India is importing 10,000 mobile phones. Okay, and we are importing from a developing country, maybe Vietnam, we are importing mobile phone of a certain brand from Vietnam and certain other countries also. So out of this 10,000, maximum 3% can be the import from Vietnam. It should not exceed more than 3% in case of import from a developing country. Where an article is originating from more than one developing countries. So we are having imports from Vietnam and certain other developing countries, more than one developing countries. Then it should not exceed 9% of the total imports. So if an import from one developing country or in case of more than one developing country, then it is 9%, 3% or 9%. If the import from a country exceeds the threshold limit, then safeguard duty is applicable. Okay. And it is first, it will be applied for 4 years and then it can be extended up till 10 years. None of these specific duties like safeguard duty, countervailing duty, protective duty, none of these specific duties shall be applicable on an EOUs or special economic zone. Okay, unless it is notified. Why it does not apply to an EOU or a special economic zone? Because the manufacture of goods in an EOU is for export. It is not going to enter the domestic market. Safeguard duty, protective duty, anti-dumping duty, all these duties are charged to protect the domestic market from an excessive import of products from foreign countries. So it is to protect the domestic market. When In an EOU or a special economic zone, the manufacture is for export only. It's not going to enter the domestic market. So it will this specific duties will not apply for a manufacturer under an 100% EOU or SEZ unless they are going to sell to the domestic market. If they are going to sell the products into the domestic market, then all these duties will apply. Okay. Countervailing duty. So we have seen protective duty is a proactive measure taken by government to protect themselves, protect the domestic industry from a future threat. Whereas safeguard duty is to safeguard the industry in which the government has seen that there is an excessive quantity of import of goods, excess quantity. Okay. Countervailing duty on subsidized goods. So if the foreign country is giving subsidies to their manufacturers in order to push the goods into other countries. Okay. So we need to counterattack the subsidy that is given by the foreign country. Because if the foreign country, suppose the normal price for manufacturing a particular product is 100. 100 rupees is the normal price. In the domestic market, we manufacture it for 100 rupees. So suppose there is another country, okay, there also the manufacturing cost will be 100 rupees only, but that country is giving, government is providing certain subsidies. Government is telling, I will subsidize the transportation cost, I will subsidize the rental factory maintenance cost, and accordingly, now the total cost for the manufacturer is only 60 rupees. Now, the 60 rupee product will get imported into India. Who will buy the domestic product which is being sold at 100? Both are the same products. One is coming at 60 and one is at 100. So the main aim of Customs Act itself is to regularize the price differences to ensure that both the domestic product as well as the imported product are being traded at a normal price, having fair trade practice. So all these duties are charged in order to ensure that there is fair trade practice in the domestic market and there is no threat to the domestic manufacturers. So 40 rupees is the subsidy given by the foreign government in order to neutralize this 40 rupee subsidy that is given by the foreign government. As per Customs Tariff Act, countervailing duty will be charged on these products. So the countervailing duty will be equal to the amount of subsidy. It will not exceed, at least equal or less than the amount of subsidy that is provided by the foreign country. So here in this case, the subsidy will be either 40 rupees or between 30 to 40 rupees in order to ensure that the price becomes, there is a normal pricing in the market. Okay. So the quantum of duty, central government may impose countervailing duty not exceeding the amount of subsidy that is given. And what is the duration? It will come into force for 5 years. It can be extended to another 5 years. Same countervailing duty will also not be applied on EOUs and SEZ supplies if it is completely exported. Then we have anti-dumping duty. Anti-dumping, as the name suggests, dumping of goods into Indian market. So if the goods are being dumped at Indian market at lesser value, at a low price. Okay. So what happened in safeguard duty? Safeguard duty, there was an excess quantity getting imported into India. Whereas in anti-dumping duty, it is being imported at a very low price. Okay, more like countervailing duty, we can say. So if the normal price of a product is 100 rupees, the imported goods are at 60 rupees. So goods are getting imported at a lower price. It might not be due to subsidies given by the government. It could be because of some other reason. Okay, so it is getting imported from another country at a lower price, lower than the normal value of the goods. In such situation, again, we need to equalize the price in the domestic market. To equalize the price, we charge anti-dumping duty. Okay. So what will be the anti-dumping duty margin? It will be the normal price minus the export price. 100 is the normal price, export price. Export price means the price at which it is being imported into India. If that is 60, then the margin of dumping is 40 and anti-dumping duty will be 40 rupees. The aim is to equalize, ensure there is normal trade practice. Okay. This will be also be applicable for a period of 5 years, and then it can later on be extended for another 5 years. Okay. So it's also 5 plus 5. Then we have IGST. IGST is Integrated Goods and Service Tax. So this we know. IGST will be applicable because when the goods are being sold into the domestic market, the domestic products are subject to GST. So the imported products also should be subject to GST. Okay, because the domestic product will be sold as 100 plus 18% GST. Now the imported products price is only 100 after charging customs duty. Now we need to again equalize and bring it to 18% GST. So IGST will be leviable on the imported goods as well. Okay. GST compensation says if any of the luxury products are being imported and if the luxury product in the domestic market is subject to a compensation cess, then the same compensation cess is applicable on the imported product as well. So GST applicability is based on the GST. We need to refer to the GST tariffs also and ensure that what is the HSN, what is the rate that is being given as per the IGST Act, and what is the compensation cess that has been provided, and accordingly if there is any compensation cess that has to be charged in case of imported goods as well. Okay, so GST and cess, how it will be calculated? It will be calculated on the basic value, that is assessable value, plus basic customs duty, plus social welfare surcharge, plus any other duty. Okay, so GST calculation will be, first you have the value of the goods, that is the assessable value. On the assessable value, you will calculate basic custom duty. On basic custom duty, you will calculate social welfare surcharge. And then on the base value, again, you will add any other duty. That is, if there is any anti-dumping duty or a countervailing duty, safeguard duty that has to be charged, that duties will also be any specific duty that will also be charged. Then we will get the total value. Okay. On the total value, we have to calculate GST. Okay. 18% GST will be on the total value. Cess is on GST. Cess and surcharge is always on tax. It is a tax on tax. Okay. So social welfare surcharge, we saw social welfare surcharge is on basic customs duty. Similarly, compensation cess will be on the GST. Okay. Now we'll see the format of calculation. Okay, we'll do one thing. We'll finish this valuation rules also, and then we'll come to the format. The valuation rules, it is for calculation of assessable value, calculation of the duty, customs duty. Okay, we saw that there are two ways in which the duty can be levied. One is an ad valorem levy, which is based on the assessable value. One is specific levy. So for ad valorem levy, we need to check the valuation rules and we need to follow the valuation rules. Okay. So valuation rule says in case of values which are value of goods that is being imported into India, it will be the price actually paid or payable for the goods when it is sold for export to India, for delivery at the time and place of importation, where buyer and seller are unrelated and price is the sole consideration. So where the goods are being imported by unrelated person, price being the sole consideration, we can take the price to be the base value to calculate the tax. Okay. Now, this transaction value will be subject to certain adjustments which are mentioned under Rule 10. So the price that is charged in the invoice will be subject to certain adjustments or certain additions. Now, what are those additions? Commission and brokerage excluding buying commission. If there is any commission or brokerage that is paid on behalf of the exporter by the importer, then we need to add that, because these are all payments that has been made relating to the import of goods. So any payment made by the importer in relation to the import of goods should also be added with the invoice price to arrive at the transaction value or the assessable value. Okay, so commission, brokerage, engineering, design work, royalties, any insurance, loading, unloading charges at the exporter's port, not at the importer's port. At the exporter's port. Because the taxable point here is at the time of importation to at the time and place of importation. So as soon as the goods enter the territorial waters, import is complete. So any expense that is incurred by the importer after the goods enter the territorial waters is not part of the transaction value. Any expense incurred by the importer before it enters the territorial waters, before it reaches the port, all those expenses are part of transaction value. So commission, engineering, design work, royalty, cost of transport, and loading and unloading charges at the exporter's port, all this will form part of our assessable value. Rate of exchange, we will always go with the exchange rate determined by CBIC. Okay, board or CBIC. If you might be given bank rate, RBI rate and CBIC rate, you will be given 3 different rates and you will be asked to choose which rate you have to take for conversion of currency. You have to take the rate determined by CBIC. CBIC is Central Board of Indirect Taxes and Customs Duty. Okay, so we will see the main part here as to what has to be added, what has to be reduced. That is rule 10. Okay, while determining the transaction value, following cost shall be added into the price that is actually paid or payable. Okay, commission and brokerage except buying commission, cost of containers, cost of packing, whether labor or material, appropriate value of the goods which are supplied by the buyer free of cost to the seller, material components, tools, jigs, materials consumed in production of imported goods, engineering work that is undertaken elsewhere other than in India, necessary for production of imported goods, royalty, license fee that has to be paid, the value of any part of proceeds of any subsequent resale, any other payments that is made by the seller, by the buyer to the seller to satisfy the obligation of sale. So this means, like I said, before the goods are imported, before the import provision, before the goods enter the territorial waters, all the expenses which are incurred by the buyer, by the importer on behalf of this import should also be added to the price paid or payable to arrive at the assessable value for calculation of customs duty. That is rule 10.1. Rule 10.2, very important. What happens to the transport cost? Okay. So free on board value, you need to remember two terms here, free on board and CIF value. Free on board value is the value of that or the invoice price of the goods. Okay. To that, we need to add insurance and freight to get the CIF value. So what is the cost of insurance and the cost of transport that has to be added? Okay. If the cost is provided and it is available, then the cost that is paid for transport and for insurance that can be taken. Okay, if we are able to determine what is the actual cost of transport, loading and unloading associated with the delivery of imported goods to the place of importation, so only the transport, loading and unloading at the exporter's port is considered. Loading and unloading at the importer's port is not considered because it happens after the goods enter the territorial water, after the import is completed. cost of insurance to the place of importation. So if the actual figures are available, we take the actual figures. If the actual figures are not available, okay, cost of transport is 20% of the free on board value of goods. Cost of insurance is 1.125% of the free on board value of goods. This is very important and you should note it. It is 20% and 1.125%. Okay, if in the question insurance value and transport value is not given, you have to use this percentage and calculate what is the insurance and transportation cost. Okay. In case of air transport, the cost of transport is limited to the actual air transportation cost or 20% of the free on board cost. Okay, whichever is lower, we will take that. So in case of air transport, generally the cost will be the actual amount of or the actual cost will be higher than 20%. So in case of air transport, we can limit the cost of transport to 20% of the free on board value of goods. Okay. So what is free on board value? Free on board value is cost of production, profit to the manufacturer, freight in the foreign country, local taxes, loading charges, export duty and cess. So we can summarize that FOB value is the price that is paid or payable or the invoice price. On that you add insurance and freight. Okay, if the actuals are given, take the actuals. If actuals are not given, then you have to use the percentage, that is 20% and 1.125%. In case of air transport, the costs of transport is limited to 20% of the free on board value. Now we will see the this particular format of how you have to calculate the customs duty and the assessable value. Okay, first is the value of material, then freight insurance cost at the exporter's country, loading and unloading at the exporter's country. So all this put together, you will get the free on board. Free on board is when the goods are being boarded. What is the price? When the goods are being boarded, the price will be the raw material cost, the freight that was incurred there in the exporter's country, loading charges in the exporter's port. So up till port, exporter's port, whatever charges, whatever expenses are incurred, that will get added and you will get the free on board value. Okay, FOB. On FOB value, we need to add 10(1). Okay, 10. This is FOB value at the point, at the exporter's point. Okay, now for this we need to add other expenses which are incurred by the importer on behalf of the exporter. That is as per rule 10(1). Commission, brokerage, packing cost, engineering cost, royalty, any other payments that is made on behalf of the supplier, any kind of expenses that is made by the importer, it has to be added. You will get free on board value as per customs. Okay, so first step, calculating free on board value at the exporter's point, add all the expenses incurred by the exporter at the exporter's port up till the exporter's port. That is free on board value. Now to this free on board value, add the expenses which are incurred by the importer on behalf of the exporter in relation to the export. You add that, you will get FOB value as per customs. Now to this FOB value, we need to add freight and insurance. That is as per rule 10(2), freight and insurance. 20% of the FOB value as per customs and 1.125% of the FOB value as per customs. Okay, once we add that, we get the assessable value. Ship demurrage charges, lightage, barge charges, this we will add only if it is a generic in nature. If there is any special penalty that has been given, any kind of penalty, any fine, that will not form part of our assessable value calculation. Okay, this point also you have to remember that demurrage charges, lightage, barge charges, as long as it is at the exporter's port, it is in relation to the up till the point of the shipment reaching the importer's port, it is allowed. But if for demurrage charges is charged for overstay of the ship at the port. That will not be allowed. Any overstaying, so any kind of excess payment that is made, like fine, penalty for overstaying, excess charges being paid, all this will not form part of our assessable value computation. Okay, so first you add the expenses at the exporter's port, you will get the free on board value. Add expenses incurred by the importer on behalf of the exporter, you will get FOB value as per customs. On FOB value as per customs, add freight and insurance charges, you will get assessable value. Okay. Then we have other rules, other methods to calculate the value, but I don't think that is important from a revision point of view. It is more important to concentrate on the calculation of assessable value and calculation of taxes, calculation of duty on the assessable value, because this format is something that you have to memorize and ensure that you know all the components of this format, because it can fetch you 7 marks directly. Okay. Now we will see one or two illustrations. Illustration 1. Ramesh imported certain goods by air at CIF price of 10,000 USD. So CIF meaning it is FOB plus insurance and freight or transport. Okay. So the CIF value is 10,000. Freight paid 3,000. Insurance cost is 520. The banker realized the payment for the importer at an exchange of 84 rupees per dollar. CBIC has notified that the exchange rate is 83 per dollar. Find the value of material for the purpose of levying duty. They're asking us to find out what is the value of the material. So what is the value? Value of material? Value of material will be your FOB value. So they are asking us to calculate the FOB value. Okay, so 10,000 is the price. We will reduce freight and insurance. Okay, then you will get the FOB value. Now, to the FOB value, what you have to add? Because this is air, it's not mentioned, but I guess this is air freight. Okay, air freight paid was 3,000 USD. So, air freight, in case of air freight, air transport, the limit is 20% of FOB. Okay. So here the FOB value or the value of base material is 6480. To this we add 20% of 6480, that is 1296 will be your transport cost. Insurance, we always take it as actuals. Actual insurance is 520. So actual insurance 520 will be taken. We will get the assessable value for computation of customs duty. Now, on the assessable value, now we need to convert it to Indian rupee. Then we have to take 83 rupees, which is notified by CBIC. Okay. So if you are asked to calculate what is the value of the material for the purpose of levying duty, they are asking us to find out FOB value, CIF value as per customs. Okay, so first we have to remove the air freight and insurance, find out the base FOB value. On that, apply Rule 10(2), provisions of Rule 10(2), and then arrive at the CIF value as per the provisions of Customs Act. Next, we will see this illustration 4. From the following information, calculate assessable value customs duty payable in case of machinery imported from UK. So you have to assessable value, you have to calculate, customs duty, you have to calculate. FOB value is 25,000. Then designing development fees paid in UK, it is 1,000 rupees. So before import itself, this payment has been made. So this will come under 10.1. Air freight 10.2. Air freight is limited to 20% of FOB value. Value as per customs. FOB value as per customs. Insurance is not available, so it is again a 10.2 adjustment. It will be 1.125% of FOB value as per customs. Landing charges and transportation of material from Mumbai airport to factory. Exchange rate is notified as 10 per UK pound, and basic customs duty IGST is also given. Okay. So we have noted price being the FOB base FOB value. Okay, at exporter's port, the base FOB value is 25,000. So to this we add Rule 10.1, that is expenses incurred on behalf of the particular import, design charges that has to be added. We will get FOB value as per customs. This is FOB value as per customs. On FOB value as per customs, 20% and 1.125% will be taken. So 20% and 1.125% here. 20% of 26,000, 1.125% of 26,000. Okay, if we add all this, we get the assessable value, also known as CIF value. Now, duty has to be calculated in Indian rupee. So we need to convert. Once you calculate this in UK pounds, you have to convert it into Indian rupee. So 31,492.50 into Indian rupee. Indian rupee is 90 rupees per UK pound. So into 90 rupees per UK pound, we will get the assessable value in Indian rupee. First, basic customs duty has to be calculated, which is 10%. And then 10% of basic customs duty will be our social welfare surcharge. Okay. Add both this, you will get the total value for GST. Because GST has to be it has to be calculated. It should not be calculated on the CIF value. It has to be calculated on CIF plus customs duty. Because IGST is charged for the final price, right? For domestic products. So in similar way, for imported goods also, they have to be IGST or the GST should be charged on the total price. After adding import duty, what is the total final price at which it enters into the domestic market? On that final price at which it enters the domestic market, on the final price only GST will be charged. So you add the customs duty, you will get the total value. On the total value, 18 here it is 12%, so 12% will be the GST. Once you add this, you will get the cost of imported goods, also known as landed value. Landed value means at the time of clearance to home consumption, when it enters into the domestic market, it enters at a value of 35,23,633. It is called as landed value. Now, what is the total tax payable? Total tax is basic customs duty, social welfare surcharge plus IGST. The sum total of these three duties is the total tax that is payable. Total duty and IGST payable 6,89,308. Okay. Now, here I have not added two things, right? I did not add these two things. Landing charges and transport charges from Bombay airport to factory. So from Bombay airport to factory is a charge or an expense that is incurred after the goods enter the territorial waters. Okay, customs duty is calculated at the time of clearance for home consumption. So this expense is incurred after import, so it will not be included in my assessable value computation. Landing charges. Landing charges are also called as unloading charges at the port. So once the goods have reached across the territorial water itself, import is complete. So any landing charges, unloading charges at the importer's port, these are expenses incurred after the goods are imported. So I will not add it in the calculation of assessable value. Okay, so have a logical understanding of which expense to be added, which expense should not be added. Any expense that is incurred till the goods enter the territorial waters, till the import gets completed, all those expenses will be added to calculate the assessable value. If any expense is incurred after the goods enter the territorial waters, after the import is completed, those expenses will not be included in calculating assessable value. Okay, so customs is an easy scoring area, just 7 marks. Understanding of rule 10(1), 10(2). If you understand and if you are able to clearly identify the expenses under rule 10(1) and 10(2), you can easily score 7 marks, because FOB value is, you will get the FOB value, add 10(1), you will get FOB value as per customs. On FOB value as per customs, add 10(2) adjustment, that is transport and freight, you will get the assessable value. Once you get the assessable value, 10% is your basic customs duty. On basic customs duty, social welfare surcharge, you will get the total value for IGST calculation. Calculate IGST also, you will get the landed value. So the process or the format is very simple, very straightforward. Just ensure you remember and you're really thorough with rule 10(1) and 10(2) adjustment.